So let's talk about capital gains tax and allowances and rates. It's good to start really the foundation of tonight's webinar with some basic information. And we're going to do that process here. Now, I thought my cursor was going to work. It's not. So here's the CGT allowances. And what I've done here for you, I've put them year by year from 2014 all the way up to present day. And you'll notice that the capital gains tax allowances have indeed increased, but not significantly. You know, HMRC haven't been terribly generous with their CGT annual allowances. And this is the amount of money that of gain that you can have before you pay any capital gains tax. So currently it's 11,700. So if you had a property and you made a gain of 11,700, then you wouldn't need to pay any capital gains tax as a result. However, if you're a trustee or you want to put your assets into a trust, then you just need to bear in mind that the rates for trustees is a lot less than you as an individual, half in effect. So those are the rates. Now, let's have a look at something that came into play by George Osborne before he left. Obviously, he introduced Section 24, remove wear and tear allowance, had the 3% surcharge on SDLT or stamp duty land tax. But one of his parting gestures was that he wanted a lot of people to sell their properties to give chance an opportunity for house buyers to own property instead of those dreaded landlords that we all are. But one thing he did do is he reduced capital gains tax to 10% for basic rate taxpayers and 20% for high rate taxpayers, but not for property residential investors. So we, and I see clearly including myself here, that own residential property investments in our own names, we would still be subject to 18% CGT and 28% as a high rate taxpayer, which is the old rates. So you could argue, has George Osborne yet again, in those changes that he made, targeted landlords to get more money off them? So he wanted to introduce Section 24 for people to sell properties and yet did not lift the lid on capital gains tax rates. He wanted to keep those at the highest level, clearly trying to penalise landlords like yourself and me. Even though if he said he wants to do the right thing, then in my view he should have stripped out capital gains tax and allowed us to sell property without us being penalised and then putting properties back into circulation. That clearly wasn't going to be the case. So has it worked? Clearly not. That is the answer to that. But I do think that capital gains tax is an option, and I'm going to go through some of the things that just give you a bit of an idea of how capital gains tax really works. And I'm going to look at a basic example for you here. So this is a property that is 200,000 sales price, sold after 3 years, and it was a buy-to-let throughout the period. Now you might have sales fees. So sales fees could be estate agency fees, legal, solicitors, etc. And then your net proceeds out of that is 198,000. Now your purchase cost could have been, back in the day, if you're lucky to have such a good deal that I'm showing on my page here. But if you purchase a property including SDLT for £100,000, and then you have some capitalised items. Now capitalised items here may be that you put in a new kitchen, you created an extension on the property, and those particular costs were not, please note, were not claimed in your self-assessment. You can't have some of the repair, replace, renew items that I talked about, whereby you may replace a bathroom, you may repair tiles, and you may repaint the property. All of those items for income tax purposes can be offset against your personal income in your self-assessment. However, you can't have your cake and eat it, as they say. So you can't have the costs allocated in your personal self-assessment tax return as well as having those same costs as a capitalised cost as well, because that would be double counting. So you must, when we talk about capitalised costs, they can't have been claimed already in your self-assessment. That's why the SA is there, self-assessment. So in this example, we've got a £78,000 taxable gain before any annual allowances have been taken into account. And let's have a look at what really that means. So since £78,000 with the new 11,700 CGT allowance in place means that there is now a taxable gain of £66,300. And if you're a high rate taxpayer, as I mentioned before, it's not 20%, it's 28% because this person holds a residential buy-to-let investment. And as a result, you will be paying a tax bill of £18,564.